Outlines of Envelopes Indicator. In this video, we will learn and understand about Envelopes Indicator in detail. We will learn in this video in topic-wise. All topics of Envelopes Indicator are following these in step-by-step. 1. Introduction. 2. What is an envelope? 3. Understanding the mechanics of envelopes. 4. Practical example of a moving average envelope. 5. Envelope indicator. How does it work? 6. How to buy and sell with the envelopes indicator. A. Trading inside the channel. B. Trading for the breakdown of the borders. 7. Envelopes as a price filter. 8. The envelopes plus MACD system. 9. The envelopes plus HMA scalping strategy. 10. Parameters of the envelope indicator. 11. Interpreting envelope indicator signals. 12. Interpreting envelope indicator signals. A. Overbought and oversold conditions. B. Trend trading with envelope indicator. C. Support and resistance levels. 12. Envelope indicator versus Bollinger Bands. 13. Limitations of the envelope indicator. 14. Tips for using the envelope indicator. 15. Construction of envelopes indicator. A. Moving average component. B. Deviation and envelope lines. 16. Volatility insights of envelope indicator. 17. Practical use with breakouts and reversals. 18. Risk management with envelope indicator. 19. Time frames and adaptability. A. Suitability across time frames. B. Adapting to market conditions. 20. Key parameters explained. 21. How bands adjust to market volatility. 22. Combining with other indicators. 23. Advanced envelope models. 24. The bottom line. Introduction. The envelope indicator is a popular technical analysis tool traders and investors use to identify potential trading opportunities in the financial markets. It helps to determine overbought and oversold conditions, trend direction, and possible support and resistance levels. This indicator is easy to implement and interpret, making it suitable for beginners and experienced traders. What is an envelope? Envelopes are a technical analysis tool that plots upper and lower bounds around a price chart to show when prices move unusually far from a usual range. Often built as moving average envelopes using two moving average lines, they help traders spot overbought and oversold conditions and define trading ranges. Traders also use envelope touches or breakouts to help generate buy and sell signals. Understanding the mechanics of envelopes. Traders can interpret envelopes in many different ways, but most use them to define trading ranges. When the price reaches the upper bound, the security is considered overbought, and a sell signal is generated. Conversely, when the price reaches the lower bound, the security is considered oversold, and a buy signal is generated. These strategies are based on mean reversion principles. The upper and lower bounds are typically defined such that the price tends to stay within the upper and lower thresholds during normal conditions. For a volatile security, traders may use higher percentages when creating the envelope to avoid whipsaw trading signals. Meanwhile, less volatile securities may necessitate lower percentages to create a sufficient number of trading signals. Envelopes are commonly used in conjunction with other forms of technical analysis to enhance the odds of success. For example, traders may identify potential opportunities when the price moves outside of the envelope, and then look at chart patterns or volume metrics to identify when a tipping point is about to occur. After all, securities can trade at overbought or oversold conditions for a prolonged period of time. Practical example of a moving average envelope. Moving average envelopes are the most common type of envelope indicator.
Using either a simple or exponential moving average, an envelope is created by defining a fixed percentage to create upper and lower bounds. Traders may have taken a short position in the exchange-traded fund when the price moved beyond the upper range and a long position when the price moved below the lower range. In these cases, the trader would have benefited from the reversion to the mean over the following periods. Traders may set stop-loss points at a fixed percentage beyond the upper and lower bounds, while take-profit points are often set at the midpoint line. Envelope indicator. How does it work? The envelopes indicator offers one more option for trading in a trend channel on the rollback or breakdown of the boundaries. The tool is based on the idea of moving averages and builds a dynamic range on the price chart. Within this range, the price, as expected, should fluctuate most of the market time. In some versions of the indicator, the central moving average is also shown, from which a parallel channel is constructed. Its boundaries are shifted from the center by an equal distance, depending on the deviation coefficient. The trader's task is to determine a fair value of the asset at any time and to wait for a deviation from this value in order to enter a transaction on the expectation that the price will return to this value. A confident breakdown of the range boundaries is possible only on a strong, fundamentally justified price movement, in which case the transaction opens in the direction of the momentum. How to buy and sell with the envelope indicator. The indicator is easy to understand. It provides not so many signals, and all of them are standard. Trading inside the channel is considered the best method. If we assume that the envelope indicator determines a range of the regular price fluctuations, then behavior in the border zone determines the basic trading signals. A rollback from the upper zone, or resistance line, is a signal for sale, while a rollback from the lower zone, or support line, is a signal for purchase. Among the first supporters of the counter-trend trading based on the idea of envelopes, it should be mentioned. His proprietary indicator uses the value of a typical price instead of the closing price and builds a dynamic channel with a variable width value. Trading for the breakdown of the borders. During the calculation, the envelopes lines are too average and do not respond to the changes in volatility. That's why these signals are considered reliable only if the trend change is confirmed by an additional indicator. Envelopes as a price filter. The indicator is used to confirm entry points in the complex trading systems, for example, in case of the breakdown of an additional moving average in the channel area, and to identify a general direction of the movement. A transition of the market into a flat condition can be noticed by a horizontal position of the envelope's borders. As the inclination of the channel increases, we can talk about the emergence of a new trend. The greater the angle of inclination, the stronger the trend. The envelopes and MACD system. The tactic is simple. We combine the signals given by the indicators and open a deal when there is coincidence. In addition, it becomes possible to practice the divergences on MACD more accurately. If a max of the closed bar exceeds the upper boundary of the envelope indicator and MACD generates a min at the same time, we open a buy order, trying to catch the market during a rollback. For a sell order, we do the opposite. The envelopes and HMA scalping strategy. 3 envelopes indicators are required, with a period of 40, close prices, and MA simple method, but with different deviation values, 0.5%, 0.3%, and 0.2%. The HMA color indicator of 7, close, 0, 3 is used as a signal line. We trade the medium volatile currency pairs on the M30 timeframe. The entry to the market is after closing the key candle. Exit is on a confirmed reversal. It is highly recommended to use a trailing stop. Parameters of the envelope indicator. The 2 main parameters are the time frame for the SMA and the percentage deviation. The time frame for the SMA determines the indicator's sensitivity to price fluctuations, and the percentage deviation establishes the distance between the bands and the SMA. Traders can customize these parameters to suit their trading style and risk tolerance. Interpreting envelope indicator signals. Overbought and oversold conditions. When the price touches or moves outside the upper envelope, it indicates an overbought condition, suggesting that the asset may be overvalued and due for a price correction. Conversely, when the price touches or moves outside the lower envelope, it signals an oversold condition, indicating that the asset may be undervalued and due for a price rebound. Trend trading with envelope indicator. Traders can also use the envelope indicator to identify the trend direction. When the price consistently trades above the SMA, it indicates an uptrend, and traders can look for buying opportunities. Conversely, when the price consistently trades below the SMA, it signals a downtrend, and traders can consider selling or shorting opportunities. Support and resistance levels. The upper and lower envelopes can act as potential support and resistance levels. In an uptrend, the lower envelope may serve as a support level, where the price is more likely to bounce back up. In a downtrend, the upper envelope can act as a resistance level, where the price is more likely to reverse and move lower. Envelope indicator versus Bollinger Bands. The envelope indicator and Bollinger Bands identify potential overbought and oversold conditions and determine trend direction. However, the main difference lies in their calculation method. While the envelope indicator uses a fixed percentage deviation from the SMA, Bollinger Bands calculate the deviation using the standard deviation of the price, making them adaptive to market conditions. As a result, Bollinger Bands tend to expand and contract with market volatility, while the envelope indicator maintains a constant distance from the SMA.
Combining with other indicators can improve the quality of trading signals. Volume indicators are particularly useful. For example, when the price touches the lower band on high volume, it often signals genuine selling pressure and a potential reversal. The on-balance volume indicator, or OBV, is a good complement, as divergences between OBV and price near envelope extremes can highlight upcoming reversals. RSI, Relative Strength Index, adds an additional layer of confirmation. If the price hits the upper band while RSI is above 70, overbought, it reinforces a potential reversal. Similarly, lower band touches combined with RSI readings below 30, oversold, often mark buying opportunities, reducing the likelihood of false signals. MACD crossovers near envelope bands can provide precise timing. A bullish MACD crossover occurring as the price bounces off the lower band strengthens the case for a reversal. This combination is particularly effective on daily charts, where patterns tend to be more reliable. Bollinger Bands, when used alongside envelopes, create a dual band system. If both indicators show the price touching their respective upper or lower bands simultaneously, it strengthens the reliability of the signal. Moving average convergence offers another layer of analysis. When the price approaches an envelope band and a key moving average, like the 200-day moving average, at the same time, it creates a high probability trade setup. These combinations make envelope-based strategies more dynamic and adaptable. Advanced envelope models. For traders seeking more precision, advanced envelope models offer refined approaches. ATR-based envelopes adjust dynamically to market volatility. Instead of using fixed percentage bands, these envelopes rely on the average true range, or ATR, to determine band distances. During periods of high volatility, the bands widen to account for larger price swings, while they contract in calmer markets. Traders often use multipliers, such as 1.5 to 3.0 times the ATR, to set bandwidths. Higher multipliers suit swing trading, while lower ones are better for day trading. Quadratic kernel envelopes apply mathematical smoothing techniques, like kernel regression, to create smoother and more responsive bands. Unlike traditional envelopes, these models are better at anticipating trend changes, making them ideal for noisy markets or shorter time frames where false signals can be a problem. Adaptive envelopes take things a step further by adjusting in real time based on market conditions.
For instance, in a trending market, the envelopes might shift their center point or widen the bands to better capture momentum. Some adaptive systems even incorporate machine learning algorithms to learn from historical price patterns and refine their performance over time. Multi-time frame envelope systems combine signals from different chart periods to enhance decision-making. For example, a trader might use weekly envelopes to determine the broader trend, daily envelopes for identifying entry points, and hourly envelopes for precise execution. This layered approach helps filter out conflicting signals and provides a clearer picture for swing traders, balancing long-term positioning with short-term tactics. The bottom line: the envelope indicator is a versatile technical analysis tool that helps traders identify overbought and oversold conditions, trend direction, and potential support and resistance levels. While it has limitations, using the envelope indicator and other technical analysis tools and adjusting the parameters to suit individual trading styles can improve its effectiveness. Understanding the signals generated by the envelope indicator and incorporating them into a well-rounded trading strategy can help traders and investors navigate the financial markets more confidently.